Let's look at the third example. And this time what we're going to see is the price of the stock falls by so much that the trader or the investor is required to put more money into the account because the value of the collateral relative to the loan has dropped by so much that the loan is no longer considered appropriately collateralized. So here's the example. We're going to deposit $25,000 into a brokerage account. And so as soon as we deposit it, $25,000, the liability and equity, there's no liability, so it's just equity of $25,000. And we're going to use 80% margin to buy as many $50 shares as possible. Okay, so the long position margin rate is equal to the equity divided by the position value. And so I solve for the position value, and I see that if I want to have 80% margin, I can buy $31,250 worth of stock. At $50 a share, I can buy 625 shares. Let's just think about this again. We are arbitrarily choosing a margin rate of 80%. This is given in the question, and I'm arbitrarily saying, okay, this is how levered I want to be. The stock costs $50. How many shares can I buy? Given that I put in $25,000, I want to end up with a margin rate of 80%. And so I'm going to have $25,000 divided by 0.8 is $31,250 worth of stock. At $50 a share, that's 625 shares. And so that means I have to borrow the $31,250 minus the 25 I put up. I'm going to borrow $6,250. And so here is what my balance sheet's going to look like. I'm going to spend all my cash, so cash will be zero. Stock is going to be 625 shares at $50 a share. I'm going to have $31,250 worth of stock. My loan is going to be the 62.50, and my equity is going to be, that hasn't changed. It's the stock minus the loan, and that's the 25,000 in equity. And now I can just calculate my margin. I can see that it's the 25 divided by the 31.25, and I get the 80%, but of course this is circular. So the new question is this: how low can the stock price go before the margin rate gets to 30? And I'm not going to derive this, but here is essentially the formula. Margin rate is equal to the equity divided by the stock value. Stock value minus the loan is the equity, so that's stock value minus loan divided by stock value. And stock value is equal to the number of shares times P. And what I want to do is I want to solve for P that gives me my margin rate. And so I put P on the left-hand side, and I do a bunch of algebra, which I'm not going to do, and I end up that the price for some given margin rate and some number of shares and some loan, this is going to be the price that equates to that margin rate. And so what I want to know is what will be the long margin call price, so price, and I'm going to plug in not any margin rate, I'm going to plug in this 30% margin rate. And the reason I have plugged in 30% is if it is the case that I get down to 30% margin, there is not enough stock to cover the size of the loan for the loan to be considered safe anymore. Here, remember that I have a $62.50 loan and $31,000 worth of stock. Well, as this price gets lower and lower and lower, what I want to know is when is it the case that the equity divided by stock, which is how we arbitrarily define leverage in this particular case, when does that get to 30%? How low can this go for that ratio to be 30%? And we do a little bit of algebra, we get this formula, and I plug in the loan, which is the 62.5, the shares, which is the 625, times 1 minus this 0.3 number, this 30% number, and I get $14.28. And so what that means is when the stock is $50, I have a margin rate of 80, but when the stock price gets to $14.28 instead of 50, all of a sudden my margin rate is no longer 80%, it's now 30%. And let's just check this. I'm going to look at this and I'm going to basically recalculate my balance sheet, except with a new price. Now I have zero cash again. I have 625 shares, but now they're valued at $14.28. My loan hasn't changed. My equity is equal to the asset, which is the 89.25, minus the loan, which is the 62.50, and I have $2,675 in equity. And if I calculate my new margin position, which is equity divided by position value, the 2675 divided by the 89 1/4, I get the 30%. So I've solved for the price. Let's see what happens, not at $14.28, but let's see what happens if I end up at a price below $14.28. Let's see what happens if I get to $14. And so what I want to do is I want to calculate three things. I want to calculate the stock return going from 50 to 14. I want to calculate the equity return. And remember that the amount of equity I started with was $25,000. I want to see what's happened to my equity as I get down to this very, very low price. And I also want to calculate the new margin rate if the price goes to 14. So the first is the stock return. That's easy. 14 over 50 minus 1. The price goes down 72%. The equity, sorry, I should have gone through this first. 625 times 14 is 8750. The loan is still 6250, and so my equity is now the $2,500. And so going from 50 to 14, I have a minus 72% return on the stock. The equity has gone from 25,000 to 2,500. I've lost 90% of my equity. And note that that was equal to my original margin rate. And my new margin is the 2,500 divided by the 8750, and that is 2857. And this is important because the 2857 is below the 30%. I am now required to add more cash. And I'm going to receive what's referred to as a margin call. And what this means is the broker is calling more money from me to increase my margin amount. I must put in cash to pay off some of this loan such that the new margin rate is going to be at now 50%. And let me think about this. If I put cash into this account, that cash would then be used to pay off the loan would get smaller, the equity would get bigger, and I would pay off enough of the loan such that the equity is equal to half the value of the stock. So I need to figure out what half the value of the stock is, the difference between that and the current equity, and that's the size of my margin call in order to return the margin of the account to 50%. And so here's the idea. Calculate the dollar amount of the margin call. How much cash do I have to put in? Well, the margin rate is going to equal the equity over the position value. And so now I need to figure out what the equity has to be. Margin times position. The position value is, minus the loan, is the margin rate. Sorry, all I'm doing is I'm substituting for equity here. Position value minus loan, margin rate times position value. And then again, just swapping for the loan size. Position value minus margin rate times the position value. Slow down a little bit. So the position value is now 8750. The margin rate that I'm looking for is 50% times that. So what that means is the loan is 6250. I need to pay off enough of the loan to get it down to 4375. If the loan is 4375, that means that the equity will be 4375, and I'll be back to 50% equity. And so I must pay off enough of the loan to get it from 6250 down to 4375. I have to pay off $1,875 of the loan. This is how much cash I have to put into the account to reduce the size of the loan such that it is equal to half of the value of the stock, which means that the equity is also equal to half of the value of the stock. And remember, it's just a rule. The rule says if the margin rate gets below 30 and 2857 is below 30, then I must put in enough cash to bring the margin rate back to 50%. If I don't do that, the broker is required to sell the stock. The broker will sell the stock for $87.50, $14 a share, use the proceeds to pay off the loan, and then I get to keep the $2,500. If I would like the position to continue, then I must add cash to the account. I must add $18.75. If I add $18.75 to the account, then I can see that the loan is paid off. I get down to $43.75. The equity is $43.75, and my new margin rate is 50%. And so this is the mechanics, this is the calculation and the mechanics of a margin call. Again, what happens if I don't add the cash? Then the broker closes the position and uses the proceeds to pay off the loan. I want to be clear here. The broker doesn't close the account. They just close the position. They sell the stock, use the proceeds to pay off the loan. There's still more value of stock than there is the loan, but not enough to keep it going.